Okay, so this is part two, value investing, what's left of it, January 25th, 2011, Ron Hosen, lucky bastard, who has a good record. Okay, so let me give you the idea that I had. That's not necessarily a good idea, but I put my niece's money into it. I purchased for her about maybe 15% of her portfolio. A mutual fund called Third Avenue Focus Credit Fund. Third Avenue Value has a number of mutual funds, but they have a minimum investment of $100,000. But they brought out this new fund, believing that there would be a lot of debt that could be purchased at distressed prices, and that they are specialists at determining the true value of bonds, other debt instruments. And so I bought it when it came out at 8, and that was about 14 months ago, 16 months ago. And it's now about 11.41. So it's had a nice return, about 40% in 16 months. Now, they expected that people who held distressed debt would have to dump it at bargain prices. But in fact, the Federal Reserve System and the Treasury has been propping up bad debt. They've been trying to make sure that nobody who sunk money into a lousy piece of paper took a loss. They're less interested in whether people lost jobs, but they don't want bondholders to lose a penny. You can see that Goldman Sachs was compensated for their credit default swaps when there was an AIG bailout. Now, this was done by the Treasury, and I went into this in October of '08. You can look up my interesting remarks. But Bernanke, who's the chairman of the Fed, kept saying, but there was a contract. Now, it was the Treasury that did it, Paulson, but Bernanke kept defending it, which means that Bernanke is probably the first Jew in the history of the world to insist on paying retail, and should be remembered for this. So I also looked for other kinds of things that would take advantage of the credit crisis. I bought Starwood Property Trust. This is an REIT that buys distressed paper. And again, you know, they raised money, the idea being, boy, you know, all of these clowns that have made bad investments will be dumping them, trying to salvage something. Well, it didn't happen that way. We have a pro-clown administration. So Starwood Properties does buy distressed debt. They have some capital. They trade at about tangible book value, at liquidation value. And if they know what they're doing, it's my understanding that the commercial mortgage market is loosening up, and there are transactions now. So here's Starwood. There's something called Invesco Mortgage Capital, IVR. They buy distressed mortgage-backed securities as well as government-guaranteed mortgage-backed securities. Hatteras Financial, HTS, they buy only government-guaranteed Fannie and Freddie mortgage-backed securities. Now, because the Fed has kept short-term interest rates so low, these companies can borrow at 1.5% to 2.5% interest, and then buy mortgage-backed securities from Fannie and Freddie or Ginnie, and get maybe 3.5%, 4%. And they can use this as collateral. So each one has about $6 worth of debt. And so they own like $6 worth of mortgage-backed securities financed by borrowing. So it's been a good stream of income. So Invesco pays about 14.5%. Hatteras pays about 14.5%. Annaly Mortgage pays about 14.5%. The symbol is NLY. And what they do is borrow, because the Fed has decided to keep short-term rates low. Now, just ordinary people who are savers get screwed because they get almost nothing on their CDs. But it's made Hatteras and Invesco and Annaly a pretty penny, and they are mortgage REITs, which means they have to pay out their earnings to their shareholders. If they do that, they don't have to pay federal income taxes. So, I own these. You might look at them. When short-term rates start to go up, that'll be the time to get out. But for the moment, it's a productive trade. Well, I can't, for the moment, see anything that's undervalued until fertilizer companies come down or companies with oil reserves come down. I don't believe in the current market I think it's manipulated. I think basically it's there for traders, and I don't think it matters whether a company is good or bad. And it doesn't matter whether a company is good or bad when you're looking at possible survival and prosperity. Because if they are a privileged company, if they are in the parasitic sector, the financial sector, the legal sector, the politically favored sector, they're going to do okay, because the laws are rigged to require their services. There are some companies, incidentally, that have phenomenally well-educated workforces. One is SAI. I think the majority of their workers are IT professionals or people with doctorates, defense analysts, people whose training has been to maintain national security. But they work on defense contracts, and so their company basically makes the same amount of money every year because they're selling the services of very, very intelligent human beings. And that's worth shit. The end.